Good morning, friends. Today we are going to talk about the basic tenets of taxation, part 2. This is in continuation of what we have done in the early lecture, where we discussed about the different problems of taxations and the basic canons of taxation. So, as a continuous point, now today, the supply side tenets of taxation is our point of discussion in the beginning, and we'll subsequently look into other aspects such as the buoyancy, then elasticity of tax, etc. So let us come to the supply side tenets of taxation. So beyond some point, if somebody maybe introduce high marginal tax rate on personal income, can reduce people's willingness to work, because after a point of tax, people have a disutility. This is what is the idea behind this high marginal tax rate and an inverse propensity or an inverse tendency of paying the tax. At the same time, high marginal tax rate discourage also people from investing in education and improving their work related skill. This is again a supply side understanding. Then a high marginal tax rate encourages people to work in the underground economy. So that is, when you have a very high rate of tax for your income, then there is a lot of possibility of tax evasion, and this is what is normally people try to figure out. But in the coming lectures, which I am going to stress most of this aspect in a very different manner, we can understand that this particular observation may not be very accurate, because most of the developed nations or the welfare states, such as Scandinavian nations, their tax rate is a high tax rate exist in and the direct tax is considerable amount when you consider the countries like India, Bangladesh, or the rest of developing economy, where the developing economy though have a less tax, the underground economy is even works in a very rampant manner. For example, the books of Arun Kumar, he talked about the black economy, where his own calculation, it's around 60% to 70%. So at least in a realistic sense, some years back, our former Prime Minister Manmohan Singh reported in the Parliament that at least not less than 45% of the total GDP is under the not in the records. That is, actually there is a huge evasion. But at the same time, when we check the tax rate and effective tax network, we have a less than 15% comes in the tax bracket. So if that is the case, then this argument of when you have a high marginal tax rate, then you have high possibility is a kind of creates a sort of underestimation or an overestimation. I would say overestimation. So, or over projection. So in that sense, we need not to be too much worried about, because in the developed world you have 40 to 50, or even in certain countries in Scandinavia you have 60%, almost 60% of tax as direct tax, which is having a very high rate of tax. At the same time, your tax evasion rate is, if you compare with the other part of the world, is less. I'll come to that point later, and in the subsequent lecture we will be dealing the same in a very very open fashion, because we will discuss about the incidence of tax, and then we'll check with all this thing. So when do tax cut matter? So from that particular point, if people say that if you have higher marginal rate of tax, then this question comes when and where you have to reduce your tax. So that is why we ask this question. The concept of marginal utilities plays a very important role as far as this particular argument is concerned. As a general rule, people maximizes their own utility, that is, they make choice that maximizes their satisfaction. They look at the marginal cost and marginal benefit. They consider what is happening today as well as what they will believe will happen in the future, etc. So this is all the argument which is basically drawn from Ramsey's principle or the Middle's principles of optimal taxation, etc. So we will discuss a separate lecture on this particular aspect. So I'm not going to the details here. So our question is, if you consider largely on utility, then therefore temporary tax cut have temporary benefit. This is what is the point which we would like to make, and any change in behavior will be short-lived. If the income tax is cut for next year but not the year after, then people will work hard next year but not the next year after that. So these are the kind of tendency normally theoretically we can observe, and the permanent tax cut affects people's future and they pick up on that. So permanent tax cut affects people's utility and therefore their behavior altogether. So this is basically this introduction is the underlying principle which is known as the Hauser's law on tax cut, etc. So in 1993, William Good Hauser, a San Francisco economist, said no matter what tax rate have been imposed toward American tax revenue remained at about 19.5% of GDP. So this is a kind of observation, whatever the level of taxation or the less tax or more tax, the GSDP in proportion to tax revenue or the tax revenue in proportion to GSDP is roughly around 20%, that is 19.5%. This is what is called a Hauser's law, or the data show that the this is an inductive argument which was made by Hauser, and the US data is concerned, this is going to be a realistic one. I'll show the real data. The data show that the tax yield has been independent of marginal tax rate over the period. So the question of high marginal tax rate or lower marginal tax rate, and these questions etc. Makes sometimes stultifies all of us, because it makes no sense in some point, but doesn't mean that this theory doesn't have any sense. But the tax revenue is directly proportional to GSDP. This is what is the point. So a marginal and the absolute doesn't make much difference. So what is actually the whole issue is the total tax and the proportion of total tax to GDP. So this is what is Hauser's try to make, and the implication based on actual data is that if the government wants to increase tax revenue, we need to increase GSDP or GDP. So if you have a higher and higher GDP, then definitely you can have a higher and higher level of tax. So note that the difference between tax avoidance and tax delinquency in that sense. So if you look into the data of Hauser's law, maximum marginal personal income tax rate in between 1946 and 2014 is this thing. The blue line shows the maximum income tax rate. So maximum personal income tax at some point, that is in 50s 45 to 50 65 or 62, roughly 62, it is around 90%, and then there is a fall in the next year, there is a fall, and in 64 onwards there is a fall, and 65 this rate remained like till 82 or so, 81 or so, a level of 70%, and again there is a cut. Then you can see that over a period, that is from 1993 onwards to 2005, that with some cutting in the tax, especially due to the dot-com burst, burst, as well as the crisis in 2008. There is a fall, but that fall remained, and then they increased the tax rate. So that rate is around 40%. So maximum personal income tax, that marginal rate is around 40%. So Now, during the 40% regime of 1990 to 2050, or the 90% regime of 45 to 980 to 90% case in 45 to 62, the rate of tax remained as it is. See, look at the this data, that is the federal tax receipts as a percentage share of GDP, see, remained as 10% of income tax, and then if you look into the blue line, then total receipt, that is around 18 to 20%, between 18 and 20% over this period. So this is what is the empirical understanding of this particular law which was proposed by Hauser. So we need to be little cautious when we speak about a high margin, low margin. So that is actually gives a lot of other issues like capacity and effort of tax. So in a nutshell, what I would like to make is the following, that is in the personal income tax rate, which is 8% of the total, and the other tax like total tax revenue on the other side is 18%. All that is basically have a fixed effect over a period. So this is what we had seen in the Hauser's induction. So his empirical robust data says that with more or less stable over a period it is stable, but on a short period there is an increase and decrease, but that has remained as a stagnated or a trend which is almost like a stable trend in that sense. So this comes with the capacity and the effort, whether the capacity of the people has increased or decreased, or the effort of the government or the tax planners or the tax the government is less or high, is making this particular point important. The taxable capacity, let us discuss the taxable capacity. So represents the average or normal share of income that can be collected in the country. We have already seen that in the United States case, this is something around 18 to 20%. So this is what is called the taxable capacity over a long period. So tax capacity will depend upon again the nature of the economy and the source of government revenue. Now if tax collection over time is T, which is called tax revenue, and Y net national income, then Y by T measures the actual ratio of tax revenue to the total income. So actual tax collection may be greater or less than a country's estimated tax capacity. So tax capacity depends on the characteristics of the economy that affects the ability of the government to collect revenue. Factors such as per capita income, export volume, mineral resources, manufacturing, agriculture output, etc. So we do have actually this discussion by many economists like Chellaia, Bass and Kelly studied the tax ratio of 47 developing countries from 1966 to 71. The average T by Y ratio, that is tax by national income ratio, was 13.6% during 1966-67, increased to 15.1% in 71. So for 16 developed countries in Europe and North America, the ratio of T by Y for the period was 26.2%. For 15 OECD developed countries, the average T by Y ratio includes social security tax was as high as 36% in 74. So this is an old data set which is in fact talked about the ratio where the stability of such capacity been assessed. What is the conclusion of this study? The ratio of T by Y, that is tax ratio to GDP or national income, and the expenditure by income or national income in developing country has increased over time as the income of these countries has gone up. whereas the TY by ratio and expenditure by national income in developed countries is higher than in developing countries. So these two observations are very pertinent because the rate of tax in the developed countries is even higher, okay, in some point, because or every quarter, every point, the tax rate is strictly, imposed on different segment, especially the income tax case in the developed country. Now the observation makes a very valid point, that is these so-called the advanced countries, like high income countries or advanced countries, they do have 36%, around 36% is the tax revenue, where we have already seen that in the United States it's around 20%, one of the lowest. But that's even that is only the personal income. So that the other income comprises around this, if you calculate the indirect tax also, then it comes around this thing. But at the same time, when you check with the tax vis-a-vis the income ratio of the developing country, still 2000, when we speak today, that is in 2020, the rate is around 15% below. So our though we had actually reduced enormously the tax rates from different quarters, but at the same time we couldn't actually make much progress in the tax GDP ratio. So this is a very glaring point which I would like to make at this point. So again, when you come to the other part of the story, like the developing country vis-a-vis the developed country, it is quite obvious that developed countries or the advanced high income countries had a very high rate of tax, and that is itself shows that our earlier proposition, when you are Hauser, when you are, if you want to increase your rate of tax, then you have to improve your level of growth or development of the state. So this is very important. Now again, public expenditure in developing country over a period is given the following situation, that in France in 60 it was 35%, but in 85 it is 52%. Japan 18%, but it is by end of 85 it is 33. Now it is around 40%. So Sweden, you have again 32% to 65. Again, roughly it is 60%. Now they maintain that GDP ratio, government expenditure. In the US, you also have an expenditure which is high. So all the developing countries now considerably increased its expenditure. Now, how do a government spend on such a level? Because they do have an income, because that income is nothing but the tax source. So the average ratio of the government expenditure to GDP for developing countries increases from 16 to 23% over the period, where the growth of public expenditure in developed or the advanced high income countries has been even faster. So what is all this thing? So the estimation of, again, somebody can say that it is because of the capacity, and again it is depends on the effort, but I'll come to that effort later. But let us discuss about the capacity. Now Ty by is equal to a plus b into y by n plus c times x by y plus d times r by y. So plus your elasticity, will come to that. So a by y, where you have a y which is GNP and t is tax, n is population, x is export, and r is mining and petroleum export, because this is a very important features of the OECD countries case and OPEC country. And then a is agriculture. So you have expected sign of A, B, C, D, E coefficient, which can be anything. If C is bigger or smaller than D, then things are going to be different. I'm going to have a calculation, and this is an actual estimate which was done in the paper which I just mentioned. So where you have a Ty by y is a T by y is equal to 0.011 plus all this thing, and is estimated the level of y, which is GNP, to given a country, and value of other variables for a given country. This estimated ratio is denoted by your change in that is your t hat by Why? In this regression, the value for E was not significant, hence the variable A by Y was dropped. So this is what is their effort. But at the same time, because that is not, the capacity point is not much significance in that sense. But if you have higher income growth, then that is connected with the tax. Again, tax is connected with this. So you may be having a causality, but that portion I'm not going to discuss, because we need to check really on that. If somebody interested in this, they can very well discuss this matter. Again, if you check with the tax capacity and tax effort, then tax effort is nothing but the actual D by Y divided by estimated D by Y. So actual tax ratio with that of estimated tax ratio gives the tax effort. Okay, so if the tax efforts of a given country is less than 1, the country is able to make changes in its tax base or tax rate or both, and increase revenue without excessive difficulty. So if tax effort has to be less than 1, then only they can actually mobilize higher level of income. Otherwise, this is not going to happen. Currently exploiting its tax potential to a lesser extent than other countries with a similar economic characteristics. If the tax effort is more than 1, then the tax system is rising more tax revenue than the indicated as country's potential for tax collection. So let us look into India is having in this context 1.25. Pakistan is having 9.15, Nepal is having 4.89, Tanzania is having 1.34, Mexico is having. See, look at these countries where they have a high potential in that sense. That is, India has less, it is so costlier. That is, the effort is more than what is actually they can get. So what does it mean? It means that actually it is meaningless to spare for collection at the same time, and they can improve. So on the contrary, the reverse would happen. It is actually creates a higher cost on all of us. Whereas when you talk about the countries like Pakistan, Nepal, Mexico, see, there is a positivity that if they take some effort, then they'll get more than what their effort is. So there is a positivity. At the same time, India and Tanzania falls in the same poorer lot, even in 72-76 period, 72-76 periods of calculation as per the Chellaya and other calculation. So tax capacity and tax effort in that sense is a very tricky point, and the high tax effort doesn't necessarily mean that the country has government budget surplus or is following a sound set of economic policy. This is also widely discussed in the last government, especially in the last UDF government, where the rate of tax, the revenue was falling very drastically. At the same time, even despite all the odds in this government's period also, there is a lot of improvement in collection. But at the same time, when it comes to the indirect tax, this is a little tricky, because now the government payment and other things are routed through in a different way, which is not performed as we thought of. So there are so many problems involved in that sense. Some countries have a high tax effort and yet suffer from high budget deficit because of a poor use of public sector resources. The misallocation of government expenditure is a major problem in many countries. So that is about the tax capacity vis-a-vis the tax effort. So let us go to the next level of problem, that is tax elasticity and buoyancy problem. So the response of tax revenue to change in the GDP is measured by tax elasticity and tax buoyancy. So these concept helps to explain the overall structure of a tax system. B serves as valuable analytical tool for designing the tax policy. So that is why we are interested in. So let us talk one by one. First, tax buoyancy. Tax buoyancy measures the total response of tax revenue to change in national income. Take into account both the effects of increase in income and discretionary changes, that is tax rate and base on the revenue from a tax. And tax buoyancy is a measure of both the soundness of the tax basis and the effectiveness of the past tax changes in terms of revenue collection. A tax elasticity is measures the pure response of tax revenue to change in the national income. B reflects only the built-in responsiveness of tax revenue to movement in national income. So the tax elasticity calculation excludes the impact of change in tax rates and tax base. It considers only the effects due to change in the income level, whether or not changes were made in tax structure during that particular period or time period. So let us have a measurement of tax buoyancy. Tax buoyancy can be expressed as follows. That is, I keep telling in the earlier point, if you say that buoyancy rate need to be calculated, then UEB TY is equal to change in TB by change in Y times Y by TB, where your EB is equal to buoyancy of tax revenue to income, and then your T is total tax, TB is total tax revenue, then change in delta TB is change in total tax revenue, Y is equal to income, delta Y is equal to change in income. So your change in tax, that is your tax buoyancy, is nothing but change in tax revenue, total tax revenue, the ratio of total tax revenue that of the change in income times the total income and the total tax revenue. So this is what is the thing. And buoyancy may be better expressed by breaking down the total tax system into individual taxes. Suppose there are sales tax, trade tax and income taxes in the tax system. Following relation should be whole. That is, you have a TB is equal to TB1 plus TB2 plus TB3, because you have a sales tax, trade tax and income tax. Now in the sales, instead of sales tax, you have a GST, you have a trade tax, you have an export import tax, and then you have other income tax. So then that is also represented as change in TB, that is delta TB is equal to delta TB1 plus delta TB2 plus delta TB3 plus etc etc. So this is how you calculate, where you have a revenue from tax one head, second head, third head, etc. So if you want to check the buoyancy of each, then what you have to do is the summation of all the changes divided with the change in income times the TB. So this is what is you have to do, and then you keep making disintegrating, then you get each tax, the buoyancy of each tax, such as you can get this GST buoyancy, you can get the trade buoyancy, you can trade tax buoyancy and income tax buoyancy. So if you have all these equations I'm keeping, you can actually very well refer. So the total tax buoyancy in that sense is actually the summation of all this different interactive tax system which is imposed by the government. So this expression shows how each tax base responded to change in income over time. Some tax bases may get reduces with a change in economic activity. Buoyancy is reduced if tax exemptions or tax rates are lowered over time. Again, buoyancy may also be low if the fundamental tax elasticity of tax system is low. Now let us come to the tax elasticity. Is the relevant parameter for revenue forecasting purpose. The value of the tax elasticity given in indication to policymakers of whether tax revenue will rise at a first same place as national income. Tax elasticity is the ratio of the percentage change in tax revenue to the percentage change in income or GDP, assuming that no discretionary changes have been made in the tax rate or tax base. So it is simply the percentage change in tax by percentage change in income. So this is what is your elasticity calculus. So ETY is equal to percentage delta t by percentage delta y. So this is how you calculate. Since tax elasticity is a measure of the responsiveness of a given tax structure to change in income, it is necessary to segregate the revenue effects of changes in the tax rates and the tax base from the calculation. An elastic tax system is highly desirable system as it provides the government with a sustained fiscal resource base for financing its outlays. Inelastic tax system forces a government to continuously make discretionary changes either in tax basis or in the tax rate or both. A tax system that is subject to constant adjustment by policymakers generates a greater uncertainty and has adverse effect on long-term investment due to uncertainty in tax system. A comparison of buoyancy and elasticity coefficient gives the analyst a useful insight into the tax system. These are the things when you want to compare elasticity and buoyancy of different country, which we checked with, that is during the different period, because in Bangladesh between 79 and 84 the buoyancy rate was 0.99, whereas the elasticity is 0.71. Where in Malaysia it is 1.23 buoyancy rate and elasticity is 0.50. Philippines, the buoyancy effect is actually 0.80, whereas elasticity is between 78 to 85, 0.5. Sri Lanka, it is 0.75, whereas elasticity is 7.3. Thailand is 1.13, and the elasticity is 0.92. So this is how different countries case. Although tax buoyancy is a useful tool for the purpose of policy design, the income or GDP-based revenue forecast model relying on tax elasticity for estimating future tax revenue collection based on the current tax system. The forecast of aggregate revenue in the future are done within given tax structure. We have a different case, as this is the full case where you have the buoyancy rate of different import duties, excises, turnover taxes, personal income tax, corporate income, overall tax structure in Sri Lanka. So this is a case of Sri Lanka where you see all these differences, buoyancy rate and the elasticity rate. So tax elasticity by income tax, that is personal income tax can be quite elastic if the exemptions and the deductions are limited. As more income grows, more taxpayers become subject to the income tax, and also people already in the system pay high average taxes. If personal income tax is not inflation adjusted, then amount of tax paid in real terms may grow as nominal GDP increases due to inflation. Elasticity of income tax system again depend on whether growing sector of economy are taxed or not. Now, indirect tax such as GST or sales tax, etc., where elasticity of indirect tax depends on the type of tax, whether it is unit tax or an annual or percentage tax, as nominal GNP increase due to the general rate of inflation. Revenue from unit tax remain constant in nominal value. This means that real tax revenue will fall. This causes a decrease in the ratio of tax revenue to GNP. The tax revenue from a percentage tax would increase in the same proportion as the price level, where the growth in demand of certain goods and services may not increase as at fast rate as the national income. As the per capita income of a country increases, the income elasticity of each of goods and services will change. For the indirect tax system to have a tax elasticity of greater than 1, its base will have to include a large proportion of goods and services than have income elasticities of demand greater than 1. So these are the case of computation of buoyancy with respect to GDP. In the older data, same procedure is being followed these days also. So let me skip this thing and let us go to the GDP based estimating model. So the aggregate tax revenue forecasting plays a crucial role in the process of annual budget formula. It provides policymakers and fiscal planners with first-hand insight and allows them to formulate policy options to balance the budget in short run as fiscal policy intervention to rectify financial anomalies over the medium term. First, estimate the elasticity with respect to the aggregate tax base and then forecast revenue for the future. So, dynamic versus static model says that expected to find a close relationship between tax and their basis and the revenue forecasting. For example, the amount of income tax should depend on the amount of taxable income and the tax rate. The magnitude of the income tax liability will affect the incentive to work and the results wage and salaries receive. Sophisticated econometric models can be used we have already developed and we are using it, and if that is the case, then we can actually establish linkages between the changes in tax structure and its effect on revenue. The indirect effects of income is harder to measure than the direct because the data complexity as well as the effort is huge in that sense. So once the effects are known, the revenue implications can thus be calculated. Such models are so known as dynamic models, but there's not great dynamism which is involved, but still that data is a static data, but much better data than the static 1 point data. So dynamic models take into account of the response of the tax basis when discretionary changes are introduced into the tax system. So dynamic models consider the expected behavior response of the economic sector to the introduction of new taxes or to change in the existing tax law. To capture such linkage requires a relatively large amount of solid information which may not be possible in most countries. Considering their information intensive in nature, these dynamic models are often not suitable for most countries that are trying to put a working model into place. Static forecasting models are used because of information constraints and lack of sophisticated computer and economic modeling skill. Forecasting models are based upon predetermined relationship for different types of taxes. Static models do not provide feedback between taxes and base as the bases are considered to be predetermined. Now, the GDP-based tax forecasting model as a first step require construction of data series for tax revenue and their basis for each tax. All major revenue generating tax should be disaggregated as well as their basis. The next step to collect information on the tax basis for which these taxes are collected. It may not be possible to directly quantify the legal tax basis of all tax receipts, but one can use proxies for such bases. All these tax bases are obtained from macroeconomic variables derived from national accounts and balance of payment aggregates. Estimating of tax elasticities, aggregation of the pure response of tax revenue to increase the income or expenditure from changes in revenue brought about by discretionary changes, which is called the legal or administrative examples. This can be done in two alternative ways. One is constant rate structure method and the other one is proportional adjustment method. So let us discuss first constant rate structure method. So the method is to apply the current year's tax rate and lower governing the tax base to previous year's income and to construct the adjusted tax revenue series that would have been obtained had the same tax structure been applied consistently over time. Necessary to have detailed tax base data for all the individual taxes, which can be difficult to obtain in most developing countries. This method can be used if the number of items is small, the range of tax rate is narrow, and the data can be compiled relatively easy. That is a sum exercise tax cases. For some countries, the tax data bases are so comprehensive that this kind of analysis now can be done. Okay, so the second one, as we said, proportional adjustment method, practical method, that is basically called the practical method. So based on construction of revenue series by adjusting for the effects of discretionary change introduced in tax system over a time, requires only basic information about revenue collections for constructing the adjusted tax base series. So there are people who are basically constructing all this kind in the National Institute of Public Finance and Policy, NIPFP, and they are exactly doing this thing. So details of the proportional adjustment program, that is 3 steps are involved. Compile actual revenue collection through the period, tax revenue over n period, that is T1 to Tn period. Then compile data series for discretionary changes, revenue collected from discretionary changes, that is D1 to Dn, and adjust actual tax revenue series using discretionary change coefficient, which is a coefficient which they will be preparing. So starting out from the current year's tax structure, that is Dn, the adjustment process removes the effects on revenue collection produced by discretionary changes introduced over time. For the nth period, no adjustment is needed since the tax revenue in the nth period reflects the current tax structure. So n refers to now, the present period from which the forecast is to be made. The tax revenue impact of the discretionary change in tax system DON to DN minus 1 to DN minus T can usually be found in the annual proposed budget document of the Ministry of Finance. So this is how it has been calculated. So the adjustment for the year n minus 1 is as follows, that is the AT n minus 1 is equal to Tn minus 1 times Tn by Tn minus Dn. So where ATN minus 1 denotes the adjusted series of Tn minus 1. ATN minus 1 reflects the tax revenue for the year n minus 1. If the tax system were the same as the one in the year n, adjusted series for the year n minus 2 equals the actual tax revenue for year 2 times the cumulative adjusted coefficient, which is by equation you can say that ATN minus 2 is equal to Tn minus 2 times Tn by Tn minus Dn, whole time the Tn minus by 1 minus Tn minus 1 Dn minus 1. So tax changes in current year, tax changes introduced in the previous year. This is equal to the ATN minus 1 times Tn by Tn minus Dn. So the expression may be expanded for subsequent years also. For factoring out the discretionary changes, we may calculate the value of the estimated the elasticity, that is, as I said in the earlier portion, that is estimation of elasticity is ETY for the particular tax income Y in the year 2. Then what you have to do is 82 minus 81 by y minus y2 minus 1 times y1 by 81. So the buoyancy is again in the same formula, that is equal to T2 minus T1. Okay, there is a jumping. Okay, T2 minus T1 by y2 minus y1 and divided by y1 by T1. So this is how you calculate this thing. So if adjusted tax revenue is used to regress on the respective GDP, the result is buoyant. When an adjusted tax revenue stream is employed, the result is tax elasticity. An example is following data series for tax revenue and discretionary change for a given country during the period 1 to n. So this is how it looks like. At T1 it is 100, that is D is equal to 0, whereas T2 is equal to 140, then D is 20. Okay, then D2 20, then T3 is equal to 170, then D3 is 0, so like that. So you keep having all this thing adjustments. So this is how it is, we can try and calculate. So relationship between tax revenue and tax base. The final point, that is establish an exact relationship between the adjusted tax data, that is AT, and the economic variables, which is proxy. Okay, or proxy basis. So tax is to find out which component of the national account that corresponds most closely to the base for particular tax. In the case of excise taxes, now it is all part merged to the GST, the tax levied on the sales, etc., tobacco products, etc. It want to be calculated, then the AT tobacco is equal to F tobacco sales. Then case personal income tax is actually ATPIT, personal income tax, is equal to F wage of salary, bonus, interest, dividend, rent, profit from corporate business. So this is how you name it and calculate. So value added tax is if GST is adjusted tax revenue are linked with the total consumption expenditure on goods and service, then your adjusted tax rate is going to be adjusted tax data is going to be 80 VAT or GST is equal to F consumption expenditure. So this is how it has been. So a functional form in that sense is the following, that is regression analysis carried out on forecasting future revenue collection, and the general form of forecasting model is being expressed in the following equation, that 80 is equal to alpha plus beta times Yj. So where 80J is the adjusted tax revenue in the year J, and Yj is the tax base in that jth year, and the alpha and beta are the coefficient to be estimated. Alternatively, the same relationship may be expressed in log term, which is an ln function, nothing else. So ln 80 is j is equal to your gamma plus delta times ln yj. So this is how it has been, and then you have an advantage of using log form is that the coefficient of yj, that is delta, becomes that is dou becomes the tax elasticity. So ATJ takes the form of adjusted series, and the national account component, which is used as the tax base proxy, becomes independent variable in that calculation. So the dummy variables are often introduced into the model to account for the other relevant explanatory variables in the model. That is also given in here. So suppose so that is how you calculate this two method with the help of this two method in the tax. And in the next lecture we will be discussing about the incidence and then subsequently optimal tax. With this let me conclude the presentation. Thank you for your patient listening.